That was the calculation. You put your money in the bank, get 10% interest. I never saw that.
Yeah.
Because I was the 90s and 2000s, and interest rates went from kind of 6% in my lifetime to negative. So yeah, that's what the world used to be like, is you put it in a bank because they use your money. They use your money and they should pay you for it, but they don't. And what you're saying there is you're going to take a bet that the network's going to grow because people all want to use this new DeFi technology to generate yield, because the whole insurance industry, the pensions industry is all going to move into this space because the yields are better. So those tokens will go up. So that's another way of playing. It's just own the token. So if you don't want the yield, but you believe in this decentralized non-bank finance that's taking over the world, buy the tokens. So right now, if you have a bit of savings, you stick it in the bank, you earn a big fat 0 in interest. DeFi replicates how the banking system creates interest, which is people want to borrow stuff from you, lend stuff, and there's an interest rate for that. And there's another thing called staking, which is you put your coins to secure the network and you get paid a yield by the network for doing so, some of the rewards of the network. And they generate yield. So the yields in the DeFi space, in the crypto space, are somewhere between, if you're just lending out straight Bitcoin, it's about 3%. But if you're doing other things like staking or some of these yield plays, which have a little more risk, you're getting 8, 10, 15, 20% yields. So suddenly you get interest on your savings. Now, the safest way of doing it, in my view, is stablecoins, because they're pegged to the US dollar. So there's a stablecoin like Paxos, which I think is USD. That is a very secure underlying stablecoin run by world-class people with regulatory approval, and you can lend it out via an exchange or others for about 8%. So you've got US dollar, no price risk. You don't care whether crypto goes up or down, and you're getting 8% on your income? That dawned on me recently because a mate of mine took off some of his Bitcoin bet, and he suddenly sent me a WhatsApp saying, oh my God, I've just realized I'm not going back to the financial system. Now, again, he's a lucky guy. He's got plenty of savings. He's got some income. He owns his own house. But he took some money off, some profits, and then he put it in his stable coin, and he's like, I'm now getting 8% yield on my profits. He said, why should I go back to a normal bank? And I can transfer this instantaneously anywhere around the world. So DeFi is that. Now, there's a lot of different protocols, and they're all complicated, and it's not an easy world to understand. There are relatively simple ways that you can do it with exchanges like Coinbase and Kraken and Binance and stuff like that. The DeFi protocols, you can also just own the tokens. So you find something like Aave or Compound, and you buy the token. And what you're saying there is you're going to take a bet that the network's going to grow because people all want to use this new DeFi technology to generate yield, because the whole insurance industry, the pensions industry is all going to move into this space because the yields are better. So those tokens will go up. So that's another way of playing. It's just own the token. So if you don't want the yield, but you believe in this decentralized non-bank finance that's taking over the world, buy the tokens. So there's different ways of playing the space. Now, and with Ethereum, let's say, they're moving to something called proof of stake, ETH 2.0. So proof of work is when you get, like Bitcoin, tons of computers solving complex algorithms to then say they solve the equation, they will get rewarded in Bitcoin. And that is how you make the network robust. Between that and the nodes on the network, who are the people who are kind of recording the blockchain. Because it's like owning gold with a yield, but it has the return profile of a successful startup, and it's a new disruptive business model that's eating the world, and the world's smartest people are involved in it, and it's a network of money. I mean, what is there not to love? And here's another example. So in Asia, different world. So in Asia, a Malaysian exporter exporting goods textiles to China. So what they need to do is, firstly, they need to source the cotton. So they buy that from India. They then manufacture this, sell it to China, and then the Chinese will make payment. Now here you've got a problem, is you've got Malaysian ringgit, the Chinese yuan. If you try and do that currency transaction, it's going to cost you about 10%. You're paying middlemen. Then the central bank requires all sorts of other regulation because they've got capital controls. So basically it's about a 15% cost. Now in a textile business, the margins aren't that high. So if you can go to use a stable coin instead, send instant payment or get paid by the Chinese instantaneously, and with the currency transaction included, or you do it in US dollars and it clears in seconds, you have none of these problems. So they're saving 15%. So if it costs them 8% to borrow the stable coin, they'll do it all day because they're still making another 8% extra on top. So there's different reasons why people want access. The world is also not able to access dollars very easily. So, if you're in India, for you to access dollars is not easy. So you're restricted in the number of dollars you can get access to. Well, stablecoins get around a lot of that. It makes it easy for me to send money to family in India instantaneously, or them to get money out. Now, obviously, the Reserve Bank of India wants to regulate that to make sure that the capital doesn't fly out of the country too fast, but stablecoins are a way around it for a lot of people. Getting away around the slowness and the complications of global payment rails. So when my dad retired back in 2000, I got him to stick all of his savings he lived in Spain, so in European government bonds. 5% yield. He knew what he had. Problem is they ran out after 10 years, they mature. Where were they then? 2%. What that means is his income had more than halved the next time around. And then the next time, if we were alive today, it would have been 0. In fact, negative. So,
Wow.
so all of his income has been entirely wiped out, so he now has to eat his savings. So that is what the change in the system has been. And he's anchored on the past of the 80s, where he was getting 10% interest. That was the calculation. You put your money in the bank, get 10% interest. I never saw that, because I was the 90s and 2000s, and interest rates went from kind of 6% in my lifetime to negative. So yeah, that's what the world used to be like, is you put it in a bank because they use your money. They use your money and they should pay you for it, but they don't. And so what happened in Europe, and it happened in Cyprus first, is the bank went bust. And they took all of the savers' money. Anybody with over 100,000 euros. So therefore, you're putting it in a bank, accepting the risk of the bank going bust, which historically was not the case, and then not paying you for it. That's the definition of insanity.